For decades, the Federal Reserve Bank of New York has stood as an institutional colossus on Wall Street, its influence and market savvy unmatched. Its officials moved seamlessly between public service and private gain, respected oracles who could translate the hieroglyphs of monetary policy into plain English that resonated from bank trading floors to corner bakeries. In times of crisis, like 2008's abyss, the New York Fed was our indispensable firefighter, connecting the Fed's philosophical abstractions to the market's throbbing realities. But as I've spoken to longtime denizens of New York's financial kingdom in recent months, I've sensed a concerning drift, an ebbing of the institution's gravitas and potency. The New York Fed, they lament, seems to be faltering, sapped by an exodus of veteran talent and struggling to maintain its customary command over fluctuations in the monetary tides. There used to be a lot of solid people at the New York Fed with street cred, a wistful Ward McCarthy, who spent over 4 decades plying markets before retiring in 2020 as a Richmond Fed economist, told me. That had helped us in the markets with the perceptions that these people helped to strike a balance. But most all of them have now left. The departures have been brutally lopsided, a conveyor belt transporting experience out the door. Since 2022, at least a dozen senior officials have vacated the New York Fed's corner offices, each of them carrying over a decade of institutional memory into private pursuits. The roll call includes the likes of Joshua Frost, a 24-year veteran who traded pinstripes for the Treasury Department, Margaret McConnell, who spent nearly 3 decades peering into the Fed's blind spots, and Matthew Raskin, who jumped to Deutsche Bank after 15 years. Their exits have left the New York Fed's governance, some observers contend, distressingly amateurish and green behind the ears. Does John Williams, the current president who arrived in 2018 after running the San Francisco Fed, really comprehend the frenetic cadences of modern finance? A respected macroeconomic scholar, Williams has nonetheless spent his career marooned in the ivory tower, far from the scrum of trading pits and Bloomberg terminals. He's an academic, through and through, one longtime Wall Street strategist, who asked for anonymity to speak candidly, told me over an illicitly lingering martini lunch. Williams is bright, no doubt, but he's always been more interested in the theoretical models than feeling the market's pulse. The strategist's gripe seemed to capture a broader skepticism about whether Williams' immense intellect can compensate for his detachment from the financial world's churning life forces. Williams would likely rebut such critiques as caricatures of an institution still brimming with formidable human capital. "We have an extremely deep talent pool in markets," the president assured reporters last month. And in defending his hire of Beth Hammack, the incoming Cleveland Fed chief poached from Goldman Sachs, he praised the system's diversity of expertise, saying market knowledge is now really important alongside economic comprehension. Yet for all the confident assurances about New York's bench, worrying signals persist. The New York Fed has endured stinging bouts of market turbulence in recent years that seem to catch it flat-footed. From the 2019 repo rate fiasco to last year's bond market paroxysms that forced a course correction in shrinking the Fed's balance sheet. As a longtime analyst observed, the repo saga revealed that some on the New York Fed staff lacked the market nous that had been so prevalent in bygone eras. Of course, this narrative could simply be the nostalgic lamentations of grizzled Wall Street veterans sipping one too many scotches at the Regency bar, yearning for a mythical glory era that may have never truly existed. The New York Fed's outward operations appear to be humming along, even if its internal cultural milieu has shifted. Its next crucible of market management awaits late next year when the U.S. Treasury is expected to exhaust its borrowing capacity, sparking fresh financial jitters. Still, the skepticism remains, however overheated, is a more academic, less market-grounded cadre at the New York Fed truly prepared for the fires it will inevitably face? And does the Fed's influence risk seeding to other district banks, like Dallas and Cleveland, whose recent leadership imports from places like J.P. Morgan and Goldman represent a countervailing embrace of real-world financial fluency? These are unsettled questions, and John Williams might retort that he's building the central bank for tomorrow's challenges, not reflexively clinging to anachronistic staffing models. But one truth endures: as markets convulse and asset prices swing, we will need the New York Fed, our financial first responders, to speak the language of high finance with both theoretical command and visceral fluency. Its fading luster feels like a vulnerability we can ill afford. When the next crisis inevitably erupts, the Fed may rue the loss of those grizzled market savants.